Hi, Dominique, and welcome to another edition of The Week Ahead. Sorry I missed the last 2 weeks, but I know Henry filled in very well. How are you doing?
Very well, thank you, Andrew. It's nice to talk to you again.
Yes, same. Nice to talk to you. Thank you for making the time. It's, as I mentioned, it's my wife's birthday. Happy birthday, Valeria.
Happy birthday, Valeria.
Yes. So let's dig into the past week, as we always like to do. Obviously, there was a lot going on, some maybe surprising movements in markets as well. So kind of what were your key takeaways? Obviously, the Fed being a big part of it, but everything, whatever you thought was important this past week.
So I think we're still in Goldilocks and still for some time. The Fed is going to be doing one more hike, probably in November. That's it. Unless we have an oil shock, I see them happy with inflation where it is. And since they are dovish, it will take a long time before they decide to do something about, bringing inflation to target. But basically, what I learned from Chair Powell is that he sees policy in a very restrictive, at a very restrictive stance. He thinks the real Fed funds is something like 3.5% against their estimate of R-star, which is 0.5%, so very restrictive. He didn't say it, but I think he's also concerned about the impact of the higher capital requirements that the Fed is imposing on banks on credit availability. And actually, for the past few weeks, we've seen large bank credit contracts a little bit. Okay. So he's not going to move aggressively. He thinks policy tightening has yet to fully filter through to the real economy. So my scenario based on inflation staying around 4%, is for the Fed to do one more hike in November and then stay put unless inflation starts moving up, which I don't see likely unless we have a big increase in energy prices. Instead, what I see happening is that the Fed starts taking out the 4 rate cuts. It's penciled in for next year because it sees that inflation is not coming down. And sometime around next year, if inflation is still around 4%, the Fed could start hiking again in a very gentle manner.
And then, so I guess the hikes priced in for next year are predicated upon the economy finally heading into a recession. What is do you have like a percentage chance of the US entering recession next year?
So that is based on Fed policy, essentially, because I don't see a big change in fiscal policy. So unless the Fed really gets worked up, and I don't see that happening unless we have an oil shock, I don't see a recession next year. So as long as core PC remains around 4% year on year, the risk of a recession are small, in my view.
Okay, because they won't aggressively raise rates that much more to drive it down well below 4. Yeah.
Yeah.
Okay. And then how markets reacted to the Fed. I guess any other data that came. I guess some of the data was GDP, which, I mean, obviously it's backward dating, but GDP, employment, some of the other data was stronger. Some of the prices data maybe was a bit softer. Were you surprised by the market's reaction to any of that?
No, I felt the action was more with Japan. I mean, The Fed was small beer by comparison with the BOJ. And frankly, I think the reaction to the BOJ policy changes was a bit exaggerated. But no, there was a bit of so the long end moved up after the Fed. The short end moved up a little bit, not much. I think the long end was 14 basis points the last time I looked, which was yesterday evening. And the short term, the 2-year was, I think, up 3 or 4 basis points, which seems to me quite reasonable.
Right. And some of that could have been driven by BOJ as well, or the pre-BOJ announcement and stuff. Okay. I mean, I'm still in this camp, but obviously it hasn't really completely played out, that if the Fed is willing to accept this core at 4%, shouldn't, again, I've asked you this many times, shouldn't at least the 10-year be trading higher? But I guess probably still one of the major factors, besides, duration risk, other things, insurance companies, but is still the fact the YCC and the BOJ is really holding the long end down somewhat in US or in developed markets.
Yeah, also the market seems to have extreme faith in the Fed ability and willingness to go back to 2%. I mean, look at Bs, 2%, 2-year Bs. I think 10-year Bs are barely above 2.3%. So, hey, with that sort of Bs, maybe the...
if you could buy bonds at 10-year at 4%, then that's a great deal.
It is.
Okay, cool. And then for the upcoming week, what are you thinking?
So we have the SLOS, which is a terrible acronym. It's a Senior Loan Officers Opinion Survey. That's basically the quarterly survey the Fed runs to find out what's happening to credit conditions. And we got a preview during Powell's presser. He said it was in line with previous Fed tightening cycle. So Fed hikes, bank tighten credit conditions because they expect an economic slowdown and so a worsening of credit quality. According to Chair Powell, it didn't go, the SLOS didn't show anything more than that. So that's basically what I am expecting. And otherwise, I guess even FOMC speakers have to take a break during the summer because we only have Richmond Fed President Barkin, a non-voter, speaking next week. So a fairly sleepy Fed week.
Right. Okay. Any interesting takes from clients, questions that you've had over the past week that's noteworthy, you think? Or
I mean, everybody's of course focused on inflation and what could move it up and down. I think this Goldilocks regime surprised a lot of people, and so everybody wants to know when and what could end it.
That's a good point. And for you, an oil shock is one of the things that you feel can.
Yeah, I mean, so we're talking about shock, so sharp movement in price. I think the other thing that could end the Goldilocks is the realization that goods prices are not going back to deflation. Before the pandemic, they were deflating. Now it's very unlikely that they will be deflating because of the deglobalization, the shortening of supply chains, which, by the way, I think was happening before the pandemic. We had this slowdown decline actually in the ratio of global trade to GDP before the pandemic, which no one could really well explain. And with the benefit of hindsight, I think that's what it showed, that we had reached the limit of the elongation of global supply chains. And you know how it is with shocks like pandemic. They are often a catalyst to show some trends that were going on before and we were not paying attention to. So I think, the idea that doves like Chicago Fed President Goldsby have, or the hope that goods prices are going back to deflation, I think this is going to be a disappointment, but it's going to happen. I mean, the discovery is going to happen over a few months, so it's not going to move core inflation next month or the month after that. Right.
And I guess for this coming week, the biggest stuff is also
NFP.
NFP. And What do you think?
The market has it around 200. I think this might be a bit pessimistic. I mean, if you look at other indicators, labor market indicators, like the latest one is a consumer confidence survey. Jobs hard to plentiful minus hard to find. It's up. If you look at the JOLTS, so it's lagged 1 month. Layoff rates, quits rate are still stronger than before the pandemic. So I'm not sure we get that cool down. So on balance, yeah, surprise is more likely to be positive than negative. I'll be looking at wages, of course. Now, I've been expecting a wage acceleration many times, only to be disappointed, which I think reflected the impact of energy prices on real wages and allowed employers to pay lower wages. That is probably still the case. So probably not much change there and not much change in participation or unemployment. So not a very eventful NFP, I hope.
Right. Okay, cool. Okay, cool. Well, great. It's kind of, I guess, anything we want to highlight this week. Bilal broke down his thoughts on the BOJ, somewhat moving away from yield curve control, or at least being more flexible. Varesh put out some interesting pieces on oil, and also kind of potentially interesting way to play. I think it's like a 10-to-1 bet on upside in oil, which would definitely obviously play out on your inflation. We have a few super interesting FX trades out. Obviously the rates weekly PCA work. There's a lot of super cool stuff that's out. Scandies. So please, everyone, kind of check everything out for our pro customers. Obviously, the weekend report comes out on Sunday, and we're around this week. So please feel free. Any questions, anything to follow up on, and obviously as Dominique, as you always say, any great feedback, we'd always love to hear.
Absolutely.
Cool. Well, have a lovely weekend.
You too.
Good luck,
Bye,
everyone.
everybody.
Thanks.
Good luck.
Bye. Thanks. Bye. Okay, cool. All right, awesome.
All good, Andrew.
I'm assuming it's all good. Okay, cool. All right, I'll speak to you later.
Yeah.
Think of any title. Okay, cool. Okay. Bye.
Bye.